What's up, everybody? Welcome to another edition of Zach's Live Trader. Here with you as always, I am the bearded boy wonder, Dave Bartosiak, and today, my friends, TGIF. Thank God it's Friday. Holy smokes, what a week, man. We've got a few things to cover this morning. Give you guys a few minutes to trickle on in. Michael, how you doing? Bruno, you still in Portugal, man? All the way from across the pond? Trevor, how you doing? What can I say about this week? Carnage, man. Absolute carnage. Mr. Tremblay, how you doing? I obviously I've spent a lot of time, Dr. Paul, what's up? I've spent a lot of time reflecting on the events of this week because, every night I gotta, put it together and talk to my people, make a couple moves. And then, of course, obviously, I got you guys. And I guess the moral of the story this week was that the volatility guy. What are you talking? Really, Internet Explorer? My goodness. The volatility guys have some silly trades on. Maybe not silly trades, but I don't know. They've got some interesting stuff going where they're doing these ratio spreads or where they've got not ratio spreads, but they're doing these things where they've got or is that a ratio spread? I don't know. I haven't had my coffee yet. They'll sell 3 of the front month to finance going long one of the back month. And then there's this feeding frenzy that takes place in the VIX where these guys got to scramble and make up and cover on days where we get these little spikes in volatility. I think what that means is that, and not to mention the increased securitization of volatility market in general with the UVXYs and the XIVs and VXX and all this stuff. I think what it's done is it's added more volatility to the volatility market. I know that sounds funny, but if you think about it, these are like derivatives on derivatives. So let me go in a little bit more detail here. And I got this. Remind me, we got to cover the euro. We got to cover a lot of things today. Okay, the VIX. First, I'm gonna look at the VIX. Okay, we're gonna do a little VIX lesson here. So the VIX is a measure of the variance on S&P 500 index options. So this is the spot VIX, and this is what we're talking about. When anybody says VIX, right, they're talking about the SIBO VIX. That's the pit I'm in front of when I'm on Bloomberg. That's spot VIX is what they're talking about. So basically it's based on the price of these S&P 500 options. There's, if the further out ones are trading higher, then you have more variance, right? And I mean that's an oversimplification, but it's basically the range, the expected range that the options market is pricing in for the S&P 500. Okay, so we got this spot VIX which moves intraday. I mean this is what's happening right now. And then on the spot VIX, you also have volatility futures. So kind of how we have our expirations with options, where you're going to have a September contract and then an October contract or whatever. You have the same thing with the VIX. So that's where we get that curve when we're looking at VIX Central. Let me pull up VIX Central really quickly. So that's why we get this curve, because what this is actually showing is the volatility futures. So the September volatility is at 15,250, October is 15,190, November, December, right? This is kind of cool. I love looking at this VIX curve because then you see, where's the real event risk? So the real event risk is December into January. Take a guess what we think is going to happen in December. That's right, folks, a rate hike. So it's cool to see that, right? And then now this event risk is kind of smoothing out from September through December. And well, today it's kind of a race to contango in the market. So it's some interesting stuff. Typically, you don't see this front month and dip. It usually doesn't go like that. Normally, you have kind of a a steady progression upwards. Anyway, so there's that. Then when you start talking about things like VXX, and that's very important to note here also. Look, VXX is down today. It's down 1.3%, right? But wait a minute, on that previous chart we had here, the VIX is up. So why is VXX down when the VIX is up? The obvious answer, because this is down. So if these front weeks compared to yesterday end up, or these futures compared to the other day are down, then you're going to get that negativity. Okay, so there's that. Then you have UVXY, which is actually twice what that VXX is doing. So think about the order of derivatives that we have here. First of all, the VIX is a derivative in and of itself, right? And then you have the future that's like a first derivative. Now you have VXX, which basically takes what that future thing does and adds, so essentially it's another derivative. And then you have UVXY, which adds leverage, which is another derivative. And then guys like me are trading puts on that. So you're talking like a fifth derivative product is what we're looking at. So that's crazy. But it's awesome because these move in different ways, okay? Now, I'm as twisted as this sounds. Granted, I would love it, obviously, if the VIX went down or UVXY went down and then it was at 25 today, and I could just show you guys a victory and go like, yay, that's me, spectacular. But I think it's even better that this is happening because now we can learn a little something. So I went ahead and pulled up. That's right, guys. This is a real account. This is actual money in here. Not a lot of money, but there's a little bit of money in here. And let's ignore the FXYs and the USOs for now. And let's only look at the UVXY spread. Okay? And we're gonna get to John Deere and all that other stuff later. But look at the UVXY XY spread. And Danny, this is gonna kind of help with the John Deere stuff. So I'm gonna pivot off of this to there. Okay, so here you see the price I paid for going long the 34 put, it was 283, and going short the 30 put, right? The 127 that I got back. So now here we are after UVXY skyrocketed higher right in my face. And what does this look like now? So my short end is only 34 cents and my long end is only 121, right? So I'm down. So the two of those, so 121 minus the 34, so it's 87 cents. So it's basically half, right? Not quite half, a little bit more than half, but that's where I'm at right now, okay? But that should come as a surprise to a lot of you guys, that after a week has gone by and I was firmly in the money. I mean, this spread was $3 yesterday morning. And now here we are all the way down at 87 cents. That's just the nature of these UVXY options because it moves so much. There's so much implied volatility in that thing and it whips around so much. You're always kind of still in the game. There's always a chance. So one thing I could do to manage this trade if I wanted, it's given me an opportunity here where I can close out this $30 put short, right? For 34 cents if I wanted to. So I could, theoretically, I could pay to close that out. That way I would have a gain. I'd realize a gain on this end. So I'd realize 121 minus 34. So 87. Wait, was that 121? Whoa, that's spooky. Look at that, guys. I didn't even realize that. The price that the 34 put is trading at is the same price that I sold the 30 put for last week. Ooh. Anyway. So I could book an 87-cent profit right now on the short end. And then what I would do is then I'd say, okay, well then I get to participate in everything on that 34 put. So the only reason why I should cover this 30 put is if I think that this is going to come crashing down through 30. Okay? Because then I'm like, I don't want to limit my upside, just to the 30. I want it all. So that would be the logic heading into that. If I was really convinced that, no, this thing is going to end up being in the money and I want to participate more than that, okay? At this stage of the game, I'm not really confident in that, right? Of course I have doubts on this trade because there's just so much madness that's happening right now. So, again, the only reason why I would do that is if I thought that this 30 put was eventually going to get into the money. Or I wanted flexibility. So when we were talking about that Kohl's trade before, so now if instead of having this spread that I'm kind of, committed to, if I only had this put, now let's say on Monday we get a gap down over the weekend and UVXY is at 34, right? It goes right at the money. Well, then now you're going to see those options, even that 34 or that $30 put is going to increase in value. So if I wait, maybe even I wait a couple of days, maybe let's say a rosy scenario develops and UVXY is at 32 by next Wednesday. Well, now I could sell the 32 put a little bit more money in my pocket. Of course, I would limit my upside, but it gives me options and flexibility to kind of fight my way back to break even if that's the case. So by covering this put at the $30, it gives me added flexibility for next week, okay? And it lets me manage the trade. Now, we're only looking 1 week out, but imagine if you're several weeks out, right? Kind of like this FXY. So we've got a few weeks until this FXY 86-85 put spread is going to expire. And I've got a similar scenario going on, right? Where I'm down on this. And the FXY, $85 put here has gone down from 19 cents to 10 cents. So if I wanted to, I could do the same thing where I cover that a little bit, give myself some flexibility moving forward, and kind of go from there, right? Now, I'm dealing with a 3 lot here, right? So I'm really not going to put forth much effort for over a $100 trade here. It's just, this was more for illustration purposes, because transaction costs are going to end up dipping into you if you start messing around with these a little too much, right? So, but the longer out you go, the more you can manage these, over the long run. Okay? All right. Now let me get this back out of here. All right, now let's get to some relevant situations here. Well, I've got UVXY, so what is this? Put on the 38.50, 32.50 put spread that expired today. Roll it out. Okay, so depends on how much you paid for it first. See, you're in a sticky situation here, Kurt, because you are, a small rally away from that 38.50 put being well in the money. I mean, a small rally away, right? It looks like you can't look at UVXY like you do with normal anything, because it doesn't behave like that. Just the swings are so rapid. Your 32.50 is going to be worthless, more than likely. But the swings on this are so dramatic that you may be back in the money. So I mean it's a day trade, my friend. Is really what it comes down to. You got to keep an eye on this market. This is the thing I will tell you though. They do have a tendency. We're starting to tick up a little bit. This is a Friday in the summer, right? So we could get a thin to win rally today, where it's just slowly ticking up throughout the course of the day. That would put a little bit of a damper on volatility and likely put your 38.50 into the green. Now it just matters. I don't know how much you paid for that. I'm assuming your spread is what, $6, so you probably paid $2.50, $2.50 maybe. So you'd have to get all the way to 36.50. So, here's David. I missed out on the UVXY that expired 25th of August. Just leave it there. Just leave what there? I'm not sure what. Oh, look at this. See, Kurt? 39s. I mean, this thing could very easily get down to 35. Kurt, it's one of those things. You set it up. I'm sure it's not your whole nest egg in there. I think you got a chance today. Okay. And we'll go back to this. Danny. Okay. So woke up this morning. John Deere beats on EPS. Okay, the one that I put up. Oh, so you missed that. I'm leaving it out there, David. I'm leaving it out there. New money coming in. I think new money can do this again. Go out a couple weeks, 2 weeks, even 3 weeks. Put on a UVXY put spread. You're fading this volatility. Okay? It's not going to last forever. I think they're overhyped. This is like the hype machine is perfect. And I think these conditions are ripe to trade this thing. And I'm going to be trading it a lot because everybody freaks out at the first sign of whatever, right? And now, before it was, you know, and guys, I just want to be as apolitical as humanly possible here, because I really don't care. I'm not one of these guys who gets in these political battles with people, because I don't care. But it was, oh my God, Trump, Russia, and then we would get a spike in volatility. We'd realize, you know, that it's not going to happen and it's over, right? Then it was North Korea, World War III. And I was like, nope, I'm shorting World War III. Now it's Trump's a Nazi. So I'm like, okay, well, so now I got to short Civil War II. So I'm sure next week it's going to be something else. And every time it happens, I'm going to fade volatility. I'm don't think that this is over. It's not by any means it's over. It just doesn't, it's not adding up to me that this thing is over. It's just not, okay? Yes, this is not good. If you look at the S&P 500, dipping down below the 50-day, right? And then now not recovering, right, is bad. But the last time this happened was April. We spent about a week turning the corner, and then we were off to the races again, right? Here, I've been working off this fib from the May lows to the June highs. We hit an extension, and now we've come back a little bit lower, admittedly, than I thought we were going to go. But we can get to the 38 too. That's 24 and change. Plus you've got this 50% retracement, which is 24, like 24.05, somewhere like that. So there are still, you know, there's still action here. This isn't like a death rattle. And this is a scenario that's set up multiple times. Downward channel, break the channel. Downward channel, right? This is fierce. We're getting in a downward channel, absolutely. But we could break this channel very easily. I've been seeing the earnings coming in, and earnings are very strong. Oh, here's another one. Downward channel. We break the channel, right? Did you think it was going to continue to be so easy where you just close your eyes and buy whatever you want and the stock market's going to skyrocket higher? We're spoiled. We're spoiled. This is February of 2016. Without so much as like a 10% retracement, right? But if you go back further, this is a pretty good run. from the lows in '09. Like, we're still on this bullish trend line. What's going to derail this thing? Bad earnings. And we don't have bad earnings. So we don't have bad earnings. We still have very low rates. Not to mention pretty much QE in Europe. I mean, pretty much. In Japan. It's a global game. Anyway. So I don't think that the market's DOA here. This is not the end at all. Still playing off of this fib. And until we do, like, it's not over. But you gotta, like, when you hear these people freaking out, take advantage of it. Like, understand that they're, like, for whatever reason, overreacting. And they flat out are. And take advantage of it. Here's the 200 day, right? The last time we touched the 200 day was November of 2016. Back before that, we did it in June. The 200 day is all the way down under 2,400 at 2,360 in whatever. So we will hit the 200 day probably within the next 60 days, I'd say. Because the 200 day is going to be a lot higher. We're going to get in some choppiness, and we will hit it. Plus, look what happened to the Russell, my friends. So this is not good. This is not good. So the Russell dipped below the 200-day in June. It approached it in November, and it broke it yesterday. The Russell breaking the 200 is not good for small caps. It's not good for small caps. But I could extend this further. Let's see. I don't know if I can trick this software to doing this. This is what I'll do, guys. Look at this. I'm going to change to a 4-day chart, right? And now the 50 moving average, because this is the 50 of 4 days, this is the 200-day now, okay? See that? So, I'm sure this probably extends here. So the Russell had an extended period underneath the 200-day from January of 2016 through July of 2016, right? So January to July 2016. Keep that in mind, folks. January to July 2016. January, July, right? Did the S&P 500 did they care at all about the Russell? That the Russell was going through those issues when the S&P 500 went from 1,800 to 2,100? Was it worried about the Russell? No. So I'm gonna make the argument that yes, even though the Russell is a bunch of small caps and higher beta, that it does not move nor shape the S&P 500. It's the same sort of thing that was happening when we were looking at the Qs and we're looking at the NASDAQ and we're saying, oh my goodness, this is chopping down and the market's gonna, go to heck in a handbasket, and then all of a sudden we rally up and everything's fixed, right? So, okay, I'm ranting a little bit. Let me address some questions here. Guys got me fired up. Let's see. We gotta try. So this John Deere. What do we do with Deere? Can I fix DE? Buy back, short 130 call and sell 117 call. So I think going back to that UVXY thing, you buy back the 130 if you want added flexibility, and if you believe that this thing's gonna come clawing back, right? Which I don't understand. So they miss on revenues, right? And they ended up getting into this gap. I think these guys are a prisoner of circumstance. And look at them. They've brought them all the way down to the 200-day. I bet you John Deere gets back 119, 120, the top end of this gap, early next week. I would bet that it gets back to that. So if you want to play it, the way to play it is don't even worry about that 130 call that you're short. I think that thing is DOA. But you guys, did we go out to September? We went to September 8th, right? To get the added flexibility of the options chain, I think. I just think this thing is just DOA, man. So if you can find a way to fade it back to this sort of 119, 120 today, so towards the end of the day, maybe buy a weekly that expires next week on the call side, try to get you some of that. Or I think you could sell puts down here all day. It's not going to... I think the damage is done, right? So that's how I'd manage that one. Let's see what else we got. AMAT. Let's look at some AMAT, huh? AMATs. So this is what I was saying. I'm like spike and a fade, huh? I'd have to look at the details on. Obviously, I didn't look at the details on their report yet. And now I've got too many lines on my charts. It's messing me up. Are they fading this because the rest of the market is fading? No, the rest of the market's not fading. I think we get thin to win today. Why is this in the gap, though? Under the VWAP, into the gap. That's not a good sign. Early on, at least. I'm saying this could be one of those things where there's institutions that want to cut off their exposure to AMAT. They're waiting till earnings. They get this gap up, and then they just dump everything they can into it, and that's what happens, and it starts to trickle down a little bit. But I don't know if you guys noticed, we've had these where they move, and then they kind of get under, and then they just kind of sidewind the rest of the day. We haven't had a lot of great fades where it recovers at all. It just hasn't happened recently. I'm not sure why, but we're not getting those opportunities like we did last quarter. It's frustrating. Yeah, James, I mentioned FXE, and I do have FXY here. I've talked FXE, I've talked USO, I've talked FXY. So let's look at the euro. So my currency trades are not. I'm not going to say that they're not going my way. They're not instantly pushing in the direction right away that I thought, but that's okay. That's why I was talking about September 15th options on them. I still think this continues to dip, this euro. If you notice, a series of lower highs, lower lows. I think it continues to come under pressure. So I think the euro shorts are still going to work. Now, on Thursday, was it Wednesday? Wednesday, prior to the Fed minutes coming out, we looked all good. Yesterday, it looked good until the market started to fall apart. And today, it's up a little bit, but this is going to be an inside day today, I think. So it's going to be inside the range of yesterday's session, which is pretty insignificant. No follow through. I think this continues to kind of slowly step down. Now, as for the yen trade, I still don't think it's over because of this. And I don't know, Tej Dog isn't here, but he would tell you the same, pretty sure. So last time the yen came down, actually I need to zoom out a little bit more so you guys can see it. Last time the yen got all the way to sort of 108.30, 108.25, right? And then the second time it dipped, didn't quite make it all the way down, right? It's like the bid came in early and they pushed it up higher. Still to the same top. So when I saw this move, I said, oh, okay, well, we're already doing our thing. We're already on the back way up, right? That doesn't mean that this guy can't double dip, which he did. And look, I bet you they just ticked it. They barely ticked it. Does this look familiar, guys? Stop grabber. That's exactly what this is. They're going to push you back down. They are in the process of collecting stops, and I think then it goes higher. You can get all the way down to here. I mean, we can get to 108. They could tick down below 108, and I would still be bullish on this yen trade. Which, once this dips, head for the exits on gold. XAU USD, right? Yeah. Does this look? This should look familiar, guys. A little chopping back and forth, right? So as long as that yen's under pressure, gold's going to be okay. But what a perfect scenario! You've got gold. It's going to get above 1,300. Good old rope-a-dope action there. You got the yen's going to break down below 108. Rope-a-dope action there, and then they're going to force it right back up. That's what I'm betting on. That's what I think is going to happen, right? Of course, I could be wrong. Now, if I'm wrong and it snaps, then all of a sudden we got to look to get long dollar. I mean, long gold. And gold stocks. So start getting out and getting those gold miners, the GDXs, the GDXJs. I know you crazy people. Get JNUG. I'm gonna get some of this. I'm gonna go crazy. I'm gonna buy options on JNUG. That's right, you heard it. I'm gonna go nuts, and we're gonna mess around with that too. So there's plenty of opportunities coming up if gold makes that move. Yeah, they're above in the AM. Let's see how they follow through. I used to trade gold futures, and it was this is the craziest thing on earth that you can ever imagine. Yeah, look how they rope-a-dope this. Just a little tick. They're going to push higher. It's going to be substantial, Dr. Paul. They're going to push it up, try and get everybody in there, and then we'll see if it's sustainable or if they just slap it down and steal everybody's money. But there's some pretty good soap opera stories that are playing out here. So it's exciting stuff. Things are on the move, which is great. We're traders. We want it to move. It's fantastic. And then we can wait till things calm down, and then we can do more boring stuff. But right now, it's exciting, and it's giving us opportunities. So when everybody's freaking out about the market, I love it because that means things are on the move, and I can find short-term trades. When everything's boring, it's still good, right? Because I can invest for the long run, but it's just not as much fun. And when things are chopping around, let me tell you, man, it makes my life very hard. Because I run Momentum Trader. So, obviously, when the momentum leaves the market, it's hard. It is hard. Okay, let's see. Boom. Hey, those calendars might end up working out, huh? You never know. Still got a risk reward. Okay. Talked about the yen. Talked about the JNUG. And the cyclical nature, Don. The cyclical nature of gold. I like that. Let's look at that. So, September, October. Gold starts to perk up. Should we get out of our positions? At least cover all our stuff. What positions? Yeah, James, my FXY, those FXY trades. They logged me out. Hang on, let me log back in here. I'm going to show you. It was September 15th. September 15th. 136. September 15th on both of them. Okay. Because that gave me lots of flexibility. So there we go. September 15th, the 86 put and the 85 put. Okay. So there you go. Oh, Jeff, gold's going to do what gold does, and it's not going to necessarily reflect on the market. It's going to move the yen. Yen and gold are going to move in the same, well, opposite directions, technically. Dollar yen and gold will move in opposite directions, which means that actual yen and gold move in the same direction. Anyway, so let's look. So I don't know if I don't know how cyclical. I try and stay away from that like seasonal cyclical kind of stuff, unless it makes sense, right? It's like a grain or it's like a, you know. So here we've got a pretty decent period. Let's start here. Come on. So here was a real good run from late August until early October that year. Then we've got, happened a little earlier. Here's a July to late August. So I don't know. A little bit of negativity here too. So yeah, I mean, I try and shy away from, I guess, the cyclicality arguments unless it's something that makes it has, like, you know, seasonal demand trends or something like that, right? And I know with gold we used to talk a lot about wedding season in India. I know that sounds funny, but they spend a lot of money on gold in India to adorn their brides, and that's like a major driver of gold demand. I know it sounds goofy, but it is. So here we go. FXYs. Why does gold trade higher in futures market before and then flat during the day? I don't know that it does that all of the time. That's like a recent thing that perhaps has happened. That happens with not just gold, but other currencies in general, because it's like the U.S. sees what happened in Asia and Europe and goes, meh, that shouldn't happen, and they fade that trade. So you'll see that not just in, like I said, not just in the gold trade, but you'll see that in a lot of stuff. Let's see if we can get, actually, well, let's do the 4 hours. A lot of times when you're looking at the 4 hour, like, let's look at Euro, actually, Euro USD. So here's a Friday, right? So basically there's this trend that happens until we get to the US, and then boom, now we dump it. All day, it's going a certain way, boom, then we dump it. You see what I mean? So they kind of flip, and then you'll get these 4 hour. The 4 hour bars are the best to look at these currencies, because you see what happens, like, oh, US must have opened, and there it is, the noon US open, and there's a move. I'm going to guess this is noon? No, 4 o'clock, okay. Boom. See, so there's these things that happen. Oh, there's Monday at noon, boom. And it's like these 4 hour blocks that happen, because you've got these 4 hour periods prior to, you know, Europe will open, they get 4 hours by themselves, the US opens, you know, 4 hours, then Europe closes, 4 hours, US closes, you know, they're kind of, you get these session crossovers, and then one closes, and then that kind of thing, right? All right. Gold death cross. Yeah, you know. Now, typically, a lot of the death crosses are just the 50-day and the 200-day, right? Or the golden cross. We could do that, Dr. Paul. We could do something with like basic technical setups. I don't I don't really use the death cross because it's really statistically or mathematically it's just like it's a coincidence almost. Like, yeah, eventually the 50 day is going to cross the 200 day when you're in an uptrend and you weren't in an uptrend before, right? So like this. So what I'll use more often is just the actual moving average itself. So in this case, it's like it's under pressure under the 200 day. Then it breaks over the 200 day. I would rather buy just a break of the 200 day than wait for the 50 day to cross over the 200 day and then buy that. So when it goes, I think it's when it breaks a major moving average, and if it continues up and it's a long-term average, mathematically, eventually, the other moving averages are going to cross over it, right? I mean, it just makes sense. So if I'm here the next day or next couple days, I know the 100 day is going to cross over, and then eventually the 50 day is going to cross over, and there you go. So the crossovers, I personally don't use them as much. A lot of people use them and swear by them, and good for them. It's just not my thing. What I use for timing mostly, I like to use the commodity channel index. I wait for it to be overbought, right? Cross over the zero line, and then there you go. So in this case, overbought, cross over the zero line. If I was trading euro, I'd be long here. So now on the flip side, as this is dipping down, commodity channel index was oversold, crossed over, is doing some switcheroos, but it's crossed over again recently, and I'm going in that direction right now. I'm telling people, yeah, I think I want to be short this euro, and I might do it next week. I'll put a couple more $100 in. I just don't want to I don't know. I don't want to overtrade, I suppose, because my thesis on euro versus the dollar is very similar to my thesis on dollar yen. So I don't want to put all my eggs in one basket, so to speak, and just lean everything, because if I'm wrong, then I'm going to be very wrong, and I don't want to be that wrong, right? I could be wrong in little bite-sized bits, but I don't want to lose everything being wrong once. That's stupid. So what's happening here on the S&P? Under pressure after the open, and looks like we're trickling up a little bit, right? Qs trickling up a little bit. VIX, I don't think I get intraday on the VIX. Oh, I do. There, VIX is down 5%. What has that done to the VXX? VXX is down 2.49, so UVXY is going to be down 5. There we go, down 5%. So it's at 39. Still painful when you're talking about me having that put spread at 34.30, right? Seems well out of the money, but remember what happened last week. I'm sure you all remember. We were up at 45, and then on Monday morning we got down to 31.57. So I'm not totally all that worried about it. Now, the one thing that's a little bit frustrating is that they do have a tendency to buy protection into the weekend. So this could linger up here, and then these Fridays, like Kurt has, could be in trouble. I mean, but we already knew he could be in trouble heading into it, right? So we'll see. Maybe when the rally continues, this dips a little bit. But I do think we open up Monday. Look, so Monday, when we opened up all the way down here, we were up a little bit, but we didn't have the huge rally, right? We were just up a little bit. So I think we end up gapping down, somewhere around here. And then let's see what happens next week. Hopefully we get past, the crazy events. The good news is the market has a very short-term memory, especially nowadays, and they just get past these things, okay? There's Deere ticking up. They're at 115. I know that's a far cry from where we were at, but I still think this thing trickles up. I think this thing trickles higher throughout the course of the day, gents. I think here's your fade opportunity. Alibaba, look at that. Figures when I get conservative and selling out of the money put spread is when the thing actually, goes up a lot. And then next week, Momo. It's so interesting that Momo just doesn't care what's happening in the market right now. This is the good part. It's so disconnected with the Chinese, Chinese stock. It just doesn't care, right? It's like, whatever. Go ahead, U.S. market. You can collapse. We're still going to play video games in China on our phones. So, no worries. Okay? All right, gents. That's all I got for you here today. Nice, quick, smooth 45-minute session. I don't want to hold you hostage for an hour if, David, it's not a terrible idea. I was talking. Who else asked me? What's his name? Who asked me? Who asked me first? James. James asked first, right? You could close those 130 calls for a nickel, because that will give you added flexibility for next week to try and fight your way back to break even. Right? It's not a bad idea. You close those out. You still have one long. Then if you wanted to, you can do whatever. You can if it spikes up a little bit, you could sell another one to try and get a little bit, more money and whatever, okay? So there you go. There you go, guys. That's all I got for you here today on our little session. Like I said, I didn't want to hold you hostage for a whole hour. If these are cool. They naturally, I'm not going to fill up time just for the sake of filling up time. Let you get on with the rest of your Friday. I've got an action-packed agenda as always, and that's it. So good luck trading out there, guys. I hope you're all victorious, and I will see you in the chat. See you later, guys.